In today's video, I'm going to show you a good example of why I don't like to buy breakouts. Most most retail traders, I've heard this many times. If such and such security can move above, a specific level, then that's their buy signal. The problem is in our modern markets, that strategy doesn't work very often anymore. Um, more more often than not, a breakout is followed by a step back. So in our modern markets, we don't tend to get a breakout and then a long trending move anymore. We tend to get more stair step type moves. So a breakout is usually followed by smart money selling into the breakout, and then you get a corrective move, and then you'll get another stair step up and the same thing. So a strategy of buying breakouts often just results in uh, a very quick drawdown on the position. So uh, I think you have to um, jettison that old kind of a obsolete strategy, and now it just works much better to try and buy bottoms. And so this is a perfect example of what I do in the SMT. Like I said, I try to take contrarian trades. So rather than buying strength and then looking for or hoping for a trending move higher, I try to buy into weakness, uh, preferably at a cycle bottom. And then, if I can time it pretty close, then usually we'll end up with some kind of a cushion. And so if a breakout doesn't follow through, then we can either place a break-even stop loss, or we can hopefully exit with a profit. So here was our last trade in the metal sector. Um, we were we bought right here on this down day. We This was 4 days into the bloodbath phase. I just took a shot in the dark. Bloodbath phases usually last 4 to 7 days. It just so happened this one lasted 10, but I took a shot in the dark that maybe that was the bottom of the bloodbath phase on day 4, or it was coming on day 5 the next day. So we bought right here. We didn't get the exact bottom, as you can see. I mean, we had a nice little bounce here. It looked like it might have been the bottom, but then we sold off a few more days. And so we had to weather a bit of a drawdown here from purchase on this day down to the bottom of this correction right here. And so once this rally started, it wasn't long before we had a nice cushion on our position. And then once we got into the middle part of this rally, then we just placed a break-even stop on the position. And then when we got this bearish engulfing candle, that made me nervous that the banks were going to try and create an undercut in gold, and I'll explain how that works in just a minute. And so we just went ahead and we took profits, got on the sidelines, and we started waiting to see if, in fact, an undercut was coming. And so we were in the triple leveraged fund. We made a nice little, I think we made 7.3% on this, which is that's a pretty decent gain for a 2-week trade. So now let me switch over to the gold chart. So here's the chart of gold, and I think for all intents and purposes, this is probably the natural daily cycle bottom, but we've had several, middle of the night attacks. That's just become common. It's one of the things you just have to accept if you're going to trade the metal sector. I've said this before. After 2009, the rules just don't apply to the banks anymore. The position limits aren't being enforced in the metals market. So the banks can use the metals as their cash cow. They can push it where they want it to go. And one of the strategies they use uh, before an intermediate bottom, and especially before they are looking for a big move, is they try to create an undercut. And I think that's probably what's going to happen here. We didn't, as you can see, this rally wasn't strong enough to turn the 10-day moving average back up. So that's a sign that this, well, I just say this was not confirmed as a daily cycle low, because it didn't rally long enough or strong enough to turn the 10-day moving average back up. So as of right now, anyway, this is still a daily cycle in progress. And I think what's um, what's probably going to happen is the banks are going to try and break this low right here. And all of the people that use the breakout strategy, the buy the breakout strategy, and bought up here when the miners made that higher high. Now the banks are going to try and push gold down. They're going to try and break this low and create an undercut that's going to stop out all of these traders that bought uh, the breakout in the miners, and it's going to create a lot of liquidity. All of those stops getting run is going to create a lot of selling, and that's what allows the banks to uh, buy at the bottom. Um, it's different for a big player. If a bank wants to enter a multi-million-dollar position, they can't just click a mouse like me or you. They need a liquidity event so that they can enter those multi-million-dollar positions without running price back up against them. So it's not as easy as just clicking a mouse. If the banks wanted to try and take a big position in GDX and they just started buying, the price is going to rise, $1, $2 or $3, and they're going to be a lot of their positions are going to be bought at much higher levels. So they need a big selling event so that they can enter their positions into that liquidity. And this is how they do it. They try to run uh, people's stops and get a big selling event, and that allows them to buy these multi-million-dollar positions without running price up, so that they can buy at the bottom. And it looks like that's what's happening here. We've had several middle of the night attacks, 8, 10, 12,000 contracts dumped on the market. The position limits are 3,000 contracts, so this is clearly not any kind of a natural event. This is a strategy that the banks use to try and set up uh, their buy at the exact bottom. So I think that's probably what's going to occur here over the next few days, as the banks are going to bring this down. They're going to try and run these support levels here and trigger everyone's stops. And most people will just panic and sell into that, and then they will damage their mental capital so much that they won't be able to buy again. And with our strategy trying to buy low, we got in. We had a cushion. When I saw the bearish engulfing candle on the mining stocks right here, we were able to exit with a nice gain on our position, and now we're in a position to sit and wait and see if the banks can accomplish that stop run. I don't know that the miners are gonna break this low. They may succeed in taking it down and breaking this low, but the miners have held up extremely well during this intermediate decline. So I think it's pretty clear there's a lot of accumulation going on in the mining stocks, and I think the reason there is a lot of accumulation is I believe this is a basing pattern, and a big one, which should produce a really big move once we break out of this. And it's my opinion that we're going to break out of this during this next intermediate cycle. So I think this is why the banks are trying to create that undercut. They want to enter really large positions and get in a position to profit from this breakout when it comes. And I think the move is going to at least test the baby bull high, and we may even go higher than that. I mean, this is about a 2-year basing pattern, so this should produce a really big move when the breakout comes, and that is a very good reason for the banks to try and create that undercut so they can top off their positions ahead of the breakout and ahead of this move higher that I think is coming.